Well, we were calling, thanks for tuning into this broadcast, of course. Of course, we were calling this budget as the Rescue Act. And boy, for the equity markets, it's certainly been one. But a conversation with our guest on the show today is never just about equities per se on a budget day, because he dissects a lot of numbers as well. And let's get him in on the show to talk about what was his first impression, or maybe not a first impression now. He's had some time to reflect over it as well. What does he think of the budget? Saurabh Mukherjea joins it. Saurabh, thanks so much for taking the time out. What do you make of this? Is it a case of no bad news being good news, or is there a lot more to it because the markets have given a big thumbs up to the budget speech?
I think more than the no bad news thing, which obviously is welcome, I think more than that, because this is the first time I think we've seen the NDA gamble on the fiscal side. So far, that's shown, the par for the course fiscal conservatism. This time they have gone for the jugular. To have the courage to say that for the year ahead, the budget deficit target is 6.8%, to basically abandon the old FRBM and give a far more aggressive fiscal path than hitherto India has demonstrated, takes a bit of courage, and credit to the FM for showing that courage. In effect, we are gambling a little bit here that the global rating agencies don't downgrade our sovereign debt. I presume they must have had some discussions with rating agencies before they embarked on this path. But it's the first time I think we've seen them take this aggressive a fiscal posture, and I guess that's what's taken the markets and even I have to confess, even me by surprise.
Sort of just a quick thought. Nobody knows anything, of course, but a recent conversations with a couple of global brokerages seem to suggest that their conversations with rating agencies also were that if countries like India or some of the others do go on and in these circumstances tinker around a bit with the fiscal deficit numbers, it's okay as long as that money is being spent for productive use. Did you get that sense? Because when I was listening to the speech, I mean, after a long time, infrastructure, monetization, divestment, it all sounded very, very capex oriented.
Yeah, so I think my reckoning is that's exactly the way they've thought it through. The fact that the FM took pains to stress that the capital budget is going to be up by 35%. My reckoning is even RevX will be up significantly, but I think she's made it very difficult by optically positioning the budget as an infra budget, as an asset monetization budget, as a budget where capex is being revved up. She's put the rating agencies in a very difficult position. I doubt that the rating agencies will now have the courage to push through a sovereign downgrade, especially since India will say that the Western Hemisphere countries, the European Union, the Americans, have been just as fiscally aggressive. So it is a gamble, but my reckoning is the government and the finance ministry has done the background spade work to make sure that there is no sovereign downgrade forthcoming. And that's why if you see the 10-year bond yield has gone up a little bit, but 10-15 bips in light of the announcement of a 6.8% fiscal deficit, 10-15 bips jump is not really a big deal. Remains to be seen what the RBI does on Friday. My reckoning is the RBI too will take the line that you just took, that this is whilst there is an expansion in borrowing requirement, the RBI will say we will try our best to accommodate the government's borrowing requirements, and I don't think we will see a big tightening of monetary policy from the RBI at least for the next 3 months.
Saurabh, did anything in the math confuse you or worry you one bit? I mean, they did mention that for the next 2 months they'll come to the market for 80 or 1,000 crores, but for FY22. The only thing that I was trying to wrap my head around was that the divestment number is a bit lower than what most people were working with. I mean, most reports that I read was about 2.1 lakh crore. They pegged it at 1.75, and the fiscal deficit number is a bit higher than again what people were working with. Any thoughts on or any numbers or any maths that you still have to wrap your head around?
So I think there's a sequence that I think she was alluding to. The sequence seemed to be that they create the bad bank or ARC. They also create this SPV for selling PSU land, and I presume that before the PSU banks are privatized, this bad bank, this ARC, will have to get into action and take some of the toxic assets off the PSU bank's balance sheet to hasten the privatization of the PSU banks. Now, how exactly the bad bank will get funded, Neeraj, wasn't made apparent. Whereas on the infra DFI, She
Yeah.
did say that the government will provide 20,000 crores. On the bad bank, I didn't hear of a number where the government will provide X amount of number. And yet it looks logical that the bad bank gets created first. That takes some of the PSU's weakest assets off the PSU balance sheets, and then you push through the two PSU privatizations that she spoke about. How the bad bank will be funded is a little bit of a mystery, especially since the PSU recap is so small. 20,000 crores is really not going to be go very far as a meaningful PSU recap. I think that's one area where it'll be great to see the details. Second is a whole bunch of duties were announced, and these looked like duties on pretty big stuff. I mean, duties on gold, duties on auto imports, duties on shrimp feed, duties on solar products. How much money India can generate from these duties, I simply don't know. And again, that's where the fine print will be useful to see. And furthermore, the most sort of, I suppose, if you have to be cynical about it, when the FM announced all the health-related outlays, Swasth Bharat, Swasth Bharat, Swachh Bharat, she said that the spend she announced are spread over 5 years. So how much of that spend is this year and how much is future focused, we don't know. But overall, clearly, to give her credit, she's saying, look, I'm not in the mood to consolidate aggressively fiscally. 6.8% for the year ahead is a big budget deficit, and therefore I don't think this is one of those years we can bicker too much about the fiscal mathematics. If the government is saying 6.8% is the target, then I think that the maths would be reasonably sound around that. I think from a stock market perspective, though, it'll be great to understand how will the bad bank be funded, how much money will it have, and how quickly will it take the weak assets of the PSU banks. Is there a sequence there around what sort of assets will be taken off PSU banks' as balance sheet at the outset?
I can ask you this question because I know you usually are not an advocate or an investor into PSU banks, etc., etc. The market seems to have given a big thumbs up to that particular pocket. Is it because the valuations are in favor, and there's this whole argument that you've made, and maybe the market makes some assumptions that ho jayega, so let's go ahead and try and do this because there are some moves and measures around this, around infrastructure, etc., etc., etc. This whole focus on manufacturing. Do you think that is what's happened today?
Yeah, I have to confess. I mean, I've never quite understood what fascination the Indian stock market has had with PSU banks. Not just today. I mean, I've lived here for 12 years, and I've been perpetually puzzled to see why fund managers go and buy these stocks. My cynicism stays. I don't doubt that the government will try their level best to expedite the privatization of a couple of PSU banks. But how exactly you and I as public investors can make money from it, I really am at a loss to understand. Furthermore, the 1.7 lakh crore target, if they push through a Concorde sale, a BPCL sale, an Air India sale, an LIC IPO, to be honest, that itself will by and large take them to their 1.7 lakh crore target. So I'm not even sure that they need to, in some great panic, expedite PSU bank privatization.
Yeah, no, that's a particular. I was actually thinking about it, that it almost actually tweeted about it, that 1.75 seems to be a very, easily achievable number, so to say.
Yeah, and remember, furthermore, there's a SPV that they're going to create to buy land from PSUs. So how you fund the SPV and how much land you buy itself could take you some way towards that 1.7 lakh crore target. So I think they've done in this whole privatization piece has been presented very cleverly. ARC banao, SPV banao, and then use that as a way to, what should I say, deep pressure, reduce the amount of pressure that the government has to deliver privatization swiftly. And by putting a 1.7 lakh crore number, the government is indicating to the financial markets that I am in no rush. I've got good assets. I'm in no rush. I will look for top dollar when I sell these assets.
Yeah, and clearly evident from the behavior in the recent past as well. So sort of my question to you therefore is, does this budget, I know one days or one event doesn't really make or change an investment philosophy, but I'm still asking you that there is such a large focus on manufacturing, stroke, capex, the textile park and all that announcement as well, plus DFI as you mentioned. Does this make you look at want to look at a pocket which hitherto you may not have, because you consistently follow that difference between the cost of capital versus the ROCE formula? But does this kind of make you think that, okay, let's try and look at some other pockets as well?
Yeah. So I think where people who sort of follow the budget and follow macro, right? They, I think, often lose sight of that. There are two different things one needs to think about. The government is thinking about growing the economy. The government wants to prioritize infrastructure, health, financial sector reform. All of that is good stuff, right? But you and I, right? Investors are not going to make money from top line growth. So, just to take an example, even if the government, pushes through road sector, further road building. I think they've done a super job on road building. The government pushes through the whole build out of the infra piece. There isn't any money to be made for the shareholders, for the investors out there, retail investors out there. Are not going to make money from roads getting built unless you can find a road builder who builds roads at a significant return on capital well above cost of capital. And that's not going to happen because it's an L1 regime. The government will, for obvious reasons and for the benefit of the country, the government will tender roads out at very expeditious contracts, which will mean that the road builder is actually not going to make that much money. So it's good for the country, but you as an investor out there watching this program are not going to make that much money buying road builders, right? Now flip the construct on its head. Look out 6 months, look out 8 months, look out a year. What are the three things we can see? We're clearly going to have gradually an increase in the funding cost, right? As the government itself said, its borrowing requirements are steep. The budget deficits are going to be high for a couple of years to come. As the government borrows more, gradually the cost of money in the bond market is going to clip up. Secondly, globally, commodity prices are rising as we go into a synchronized global recovery. What does that mean? If you have higher input costs and higher financing costs, champion companies with pricing power will be able to protect their margins. Weaker companies who don't have the pricing power will see margin pressure. So the economic growth cycle has been triggered, partly by the Western central banks, partly by the government's budget. Great news for us. We're probably looking at 2, perhaps 3 years of growth up cycle. But if you as an investor want to make money from that, look to invest in companies who can protect their margins, protect their return on capital as we go into a growth up cycle. Don't get caught in this trap of looking for companies who can grow their top line but without generating free cash flow, because you ain't going to make any money from investing in companies who benefit from top line, but the bottom line and the free cash flow doesn't come through.
Got it. Sort of last question really, and more something that you may have done in your previous avatar and not necessarily as the fund manager that you are doing right now, but not necessarily timing the market, but do you reckon that the movements will be more global oriented and people shouldn't worry too much about these valuation noises that are
there? Anybody out there who's looking at PE multiples today, you really need to go and get a checkup. You cannot be looking at PE multiples at the beginning of a 3-year or even if you're cynical, a 2-year economic recovery. We've already seen in the December quarter results 20, 30, 40% PAT growth from large companies. And remember, the December quarter results don't have a favorable comparable. It's not as if December, the year to December 19 was some sort of affected quarter. Now that the year-on-year comps from this quarter onwards, the year-on-year comparables here will become obviously favorable. You're going to get 30, 40, 50% earnings growth for 3-4 quarters. And if you are looking at PE multiples, then God help you, you will miss out on probably the best stock market rally in say the last decade and a half.
Great. Saurabh Mukherjea, appreciate you taking the time out and joining us for decoding this budget in your sense. Thanks so much.
My pleasure, Neeraj. Thank you for having me. Thanks a lot.
The pleasure was ours. And viewers, thanks for tuning in to this broadcast.